Hello everyone. Thank you for tuning in. Sorry for what happened this afternoon. There was a problem. There was two webinars scheduled for the same time, although we were in different time zones. So that was resolved by me postponing mine. So this is Theunis Kruger here, Forex time trainer for South Africa, and we're going to have an interesting session today. Right. We're going to talk about the moving average spring strategy, simplified. Now, before we begin, as usual, I just want to check if you guys can hear me, if you can see me. I've got a improved headset with voice, noise cancelling, so that the whole neighborhood's noises is not also recorded. So I'm just checking. I know the sound from my side looks right. The microphone looks right. The headset looks right. Please, can you guys just respond? If anybody can hear me, there's 6 people. Let's just see. Okay, Hervé, Ignas, Jezreel, Rulof. I see some new people. I see some old people. Old names, new names. Can you guys hear me? If you can hear me, please respond so that I know I'm not talking to myself here. Ignas says yes. Right. Normally I'd like to see at least 2. Jezreel. That's good. That's good. I say thanks. No, I'm not. I know I'm on the air. Right, guys. The moving average spring strategy is simplified. I've been sharing this strategy with a lot of people. It's very basic. It's very powerful. But I've had I've had some feedback about it, and that it's that the people get lost. So before we actually begin, I'm gonna show you what I mean. Right. I've got a couple of examples here. You'll remember that I always, when I train people, especially, I go to the basics. We get to know the language of the market. That's another. The structure of the market. That's another webinar I have, seminars that I hold. If you haven't listened to that, if you don't know what I mean when I talk about the language of the market, the structure of the market, then please go. We're going to discuss it now a little bit, but you need to go and listen to the Foundation of Online Trading or the Gift of Online Trading. It's on the recorded webinars. Right. So this is where we start. We keep it simple, very, very simple, especially in the beginning. Now, just to show you why I've got the feedback, this is the moving average spring strategy, the normal one. All right. So there's a couple of indicators. There's 4 indicators. And for some reason, and I can understand, some people in the beginning, they get lost. They feel they don't understand this. They get a bit confused. So I've played with a few options while I'm training people, asking them. Firstly, I took the line chart to get all the noise away. In the beginning, that's important. You need to focus on the fundamentals, the basics, because if you haven't got the basics, you don't understand that, then you do get confused, especially at the right side of the chart here. That's the important side of the chart, right? So I've simplified it, and then I even simplified it more. And the reason for that is you can see the price. You can see the structure of the price. It's very, very easy if somebody starts practicing. If you get confused, I get even feedback from experienced traders. Sometimes they distraught about something, and it's like they get confused, and then they just need to fine tune themselves again, to get in tune, to calibrate themselves. And the best way that I found is to just get the basics, absolute basics, and just draw in these beautiful trend lines and start seeing the rhythm of the market again. Now, as you can see, what I've done is I've removed everything except the 15 and the 34, 15 and 34 simple moving average, right? So they are in fact almost like a dynamic, a pair of dynamic trend lines that's helping you to identify them. Right, so that's the purpose of this. Let's go back to the presentation again. Right, so what I'm going to do is I'm going to basically, just like I have a presentation for the moving average spring strategy, I'm going to run through this presentation, and you guys can learn, you guys will learn and grow, but also I'm recording this so that I can refer people back to it. So it's for learning purpose, it's very important to repeat. What happens in our brains, the way we designed, is when you learn, neurological pathway is laid down, right? And when you repeat, that's why they say repetition is the mother of learning. As you repeat, those neurological pathways becomes like networks, like little trees. And the more you repeat, the more you practice, the better you get. Walking, talking, any skill that you can think of. That's how it works. Right, it's going to be the same this way. Right. Okay, so we're going to have a short introduction. We're going to talk about technical analysis. Um, I'm going to show you superb method. I'm going to show you effective method. I'm going to show you some indicators. And we're going to run through a couple of trades, short and long trades, where I'm going to illustrate to you exactly how I implement this. Right. And the feedback I get is very, very good. It's simplified. We do go from the line chart to the candle chart or to the candlesticks, but only when the market gives us permission, only in the early stage of the next trend. So we know where to place our guidelines. We know where to put where the market is going to show us where to put our entry and our exit and so on. Right, very, very important. We listen to the market in this business. We don't try to tell the market what to do. That's absolutely disastrous, right? Okay. And then risk management, a quick overview of risk management. A lot of people make it very complex, but it's not. It's just two things. It's just how much you risk of your account, and the less you risk, the less stress there is. That's just a fact. And I don't care how good you can trade, right? And then the second part is where do you how much you trade with your account, how much of percentage-wise of you do you trade per trade, and then is where do you take your profits, right? How do you take your profits? Do you have a high probability or low probability way, right? And then we're going to talk a little bit about your rhythm. The market has a rhythm, yes, but you have a rhythm also, and you're going to get to know it. And your rhythm is going to be unique. The time frames you like to trade, the instruments you like to trade, the times that your schedule, where you're going to trade. That's going to be your rhythm, and it's very, very important. Because this is a business, this is not entertainment, this is not a hobby, this is not something, I call it the entertainment trap that people fall into, and they can jump between methods and stuff forever. If you understand the language of the market, and you've got a simple method like this, then you can actually make a net profit over a series. If it's possible to make a net profit over a series of trades, right? So let's start with the introduction, very, very quick. This is something I've learned from our head of education, professor, we call him Prof. Andreas Tarasinos, a very clever guy, and he's really a gifted educator. Benjamin Franklin, tell me and I forget, teach me and I remember, involve me and I learn. So if you're just listening to me today, there's a good chance you're going to forget most of it, right? If you're really listening and you've been playing around, you understand, and you feel I'm teaching you, then you're going to remember. But if you are involved, right, if you open your charts, you check if you've got two screens or whatever, if you write down, you take notes, you're involved. When you're finished, you go schedule time for yourself, you study, you check what is the structure of the market that this guy is talking about. What does he mean? What is the language? Where does the market tell us? And you get to know this, then you will learn, guys, and then this will work. That's when you are working in line with how your brain is designed, repeating, digesting, thinking. Right. It's like that with any skill. So let's continue. Very, very important, the foundation of our business. We do technical analysis. We learn about the language of the market. Right. That is supported by three things: a very, very simple and well-defined method. If it's not simple and well-defined, you get confused. You get analysis paralysis. You get decision-making fatigue, all those sorts of things. Very, very, very important. Risk management or the money management. How much do you trade with of your account? How much are you risking? Where do you take your profits? Very, very important, right? And the most important of all, the most crucial one actually is your mind. If you take this, you practice, you take it slow and you go, then yes, it will work. It can work. But if you try shortcuts, then it doesn't work. Okay, it's very, very important to understand the flow and the rhythm of the market. I tell guys to, before you trade, close your eyes. Imagine that you're sitting on the beach and you're hearing and you're seeing those waves. The market is like the waves, like the ocean. The waves come. Just use your imagination, see it, get calm. Don't be stressed. See that wave. Just as the ocean waves come and they keep on going, just in that same way, the market waves, when you start seeing the structure, the market waves come over and over and over and over. We don't have to force it. We wait for the market to tell us where. This is the purpose of this. And very, very important, right? What is your own? Work out your own, right? With any business, with any, like a shop, like any service, you've got your own rhythm. When do you open your shop? When do you close your shop? Right? How are you gonna schedule? When are you gonna trade? What is your available time? What is the time frames? You figure that out and you practice those things, and you slowly build yourself up, and you become more proficient. Right. So what do we say when we talk about the language of the market? We see the structure here. That's part of the foundation. I'm going to stand still too much. We see uptrends and downtrends, and we can define them. And as soon as you can define them, as soon as you've got the ability to define the structure, just like any language that's got structure, grammar, nouns, whatever, then you can define what technical analysis is in effect. Is we're looking at this price charts, and we're waiting, we're trying to identify the early stages of a next trend. There you can see, if you can see the structure, then you can see the early stages of the next trend. Just common sense, guys. And if we are willing to take a calculated risk somewhere there, then the probabilities or the odds are for us, in the sense of that the calculated risk we take there is less than the potential profit we can make. And that's what business is all about, right? Those is the areas that you have to train your eye to see, and you have to train it well. Because if you try to go live, even on a demo, and you haven't trained this, then you will feel the pressure, right? In the end, we go to a demo just to practice our executions. After we've practiced this and we can see this, right? So based on what I've said, simplicity, I ask this question always: what do you think about the superb method that you can buy on the internet? Many methods that looks like this, and people in the beginning tend to think, yeah, now this looks very complicated. Man, this must be good. So if you still think that, then sorry guys, confusion here. You're not focused on the price. Clashing indicators easily happens a lot. So this is not what we're after. This will not make you successful. Right, that's my opinion anyway. Okay, right. So let's look at another type of method. The moving average spring strategy is still the same basic concept that I use. We've got a spring. We can press the spring. When you compress the spring, there's only one way the spring wants to go. We know this, right? So let's look how this happens in the market, or how we can use this picture, this mental picture, to prepare us for what we want to do in the markets, to take a calculated risk at a certain stage, right? What you can see here is the market was going lower. There was some ranging market, and then the market went lower tops, lower bottoms, right? So, but what happened there? For some reason, we don't know. You have to know. We can see it did make a lower bottom there. That means something is happening. A balance. There's a shift in balance between the buyers and the sellers, the bulls and the bears, the demand, supply, and the demand. Right. We do not have to know why. We can see. This is the language of the market. We can see there's something happening, and like that spring, what happened there is the sellers took the price very low. Sellers were selling, and the price is compressed at that stage. So if it starts giving you a warning, then what is going to happen? There's a good chance, there's a good possibility, and we always guys think in terms of possibilities. That's a very specialized field, neuro-linguistic programming. What you say has an effect of how you think, right? If you think ever that you can predict the market, you are wrong. There's just too many variables, too many people involved, different strategies. Nobody knows what the price is really going to do. So that's why we take a calculated risk. So what happened here is the fundamentals, or the basic says there was more sellers than buyers. The price went down. Something happened here. There's a shift, and the market starts going up. We are willing to take a calculated risk because we never know what the market is going to do. It might just go up to there and then jump down. If we had taken somewhere their calculated risk, then we will just protect our account, right? Losses in this sense is part of a good trade, and it's a good thing because you're protecting your account. You're preventing larger losses and wipe out of accounts. I talk to so many guys that wipe out their accounts in this way. They trade well and then they start thinking, no man, I can do this. I can predict the market, and then they stop using stop losses. Yeah, it's not nice to lose their account. Right. Okay, price is king. We focus on the price. I cannot stress that enough. There's no indicator that lags. Well, there's no indicator that really uh, that's really as specific or as accurate as the price, right? If you understand the price, if you understand those waves, you understand what that means. Yes, you're allowed to use an indicator to support you, right? But it must never become your focus. Price is king. It is our focus. Period. Right. So I've simplified this. What I'm using in this stage is this 34 simple moving average. And as you can see, that's almost like a dynamic trend line that draws for us, right? It's got a purpose, and that's to show us it's not as accurate as the ones we draw with our hand. But when we've mastered this, when you've drawn that over and over and over, and you can see that, then you only need this to actually show you or to help you to see, yes, obviously this is a downtrend. We can see this. Right, here it breaks the downtrend. It helps us to identify the early stages of the next trend. All right, then I've added another one for a very specific reason. The 15 simple moving average. Okay, guys, if you want to ask any questions or anything, please let them rip. I'll check now and then try to answer your questions. Rolof, yeah, welcome here. Okay, all right. An interesting thing that you will see. This is not so much of an issue in the higher time frames because the stable, there's a lot, like this is a 4-hour chart. There's a lot of people involved. This is the closing prices of the for every 4 hours that's connected. So in 4 hours, there's a lot of people that trade. So this band that it creates, this almost like a tunnel that it creates, helps me on the lower time frames where there's more noise. So sometimes you get these pullbacks in the lower time frames that causes like false breakouts. So this band helps me to this tube helps me to tunnel, whatever you want to call it, helps me to identify and prevent that. On the higher time frame, because the structure of the market is more stable, then it's not so it's not so important for me. But still, I like the breakthrough and so on. Okay, so that's the two indicators we use. That's it, guys. Simple, and so that's how your chart will look. So what we're going to do now is we're going to analyze this chart. We're going to look at a couple of examples. Long trade, short trades, and then remember what I said, simple and well defined. Right, we stay on the old charts. We stay on old charts, historical charts, practicing for a very specific purpose. We don't jump to live opening and closing trades too quickly, because if this is not cemented, this structure and the way where you're going to enter specifically is not cemented in your brain, the template in your brain is not well practiced. Every time you practice, I tell guys, call it research and development or whatever, and spend time, make sample sizes of 10, let's say 10 trades. You say, okay, for example, there I would have traded, there I would not have traded. Do 10 of those, simulate it, write down, was it a break-even trade, a loss or a win? And you start building confidence in how you interpret the structure of the market, and how, if you look for the early stages of the next trend and you take a calculated risk, how the possibilities there to make a net profit over a series of trades. Right, in this sense, I want to bring in a little story for you guys. Right, and I'll explain the significance. Now it's actually a fable, and it's about a jackal. It's in the African bush, yeah, in the Transvaal, old Transvaal, now it's Gauteng, Bushveld. And this jackal was walking, and he's very, very hungry. His tummy was grumbling. And he was walking past. Now, one of the staple foods of jackal is guinea fowl. And he was looking, and he heard some noises up in a tree, and he saw this beautiful fat guinea fowl sitting there, and he was just very, very hungry. Now he started looking for places, for a way to get a lunch or dinner or whatever time it was. Right. And he's a clever guy. Foxes are clever guys in the fables anyway. And what happened is he's walking around and he sees, oh man, there's no way I'm gonna get these guys. They chose their tree very well. There's no way I'm gonna get up there. So now he has a choice. He can sit there and moan and feel sorry for himself, or he can decide, let's go on. So he said to himself, remember neuro-linguistic program, he said to himself, all right, it's no use walking around here with all these skinny guinea fowl there up in the tree. And then he walked off. right? So what he did was he told himself, listen, I'm not going to waste my time here. Let's change the picture in my mind to there's not a good opportunity here. I'm not going to waste time here. Let's move on, right? And the fact that he spoke to himself and he said, let's change it. Now it's skinny in my head. It means that he can forget and he can go on. Right. So it's impossible for him to get those guys. He's decided that, but time is a problem, or time, he has a limit. If he doesn't eat for too long, he's going to die. So he has to move on. So he did something to help himself move on. Now, the reason why I tell you this fable is there's not every, I've marked the early stages of the next trend here. Here you can see the trends, up, down, up, down, up, down, up, down, very clear. All right, this is the early stages of the next trend. Now, not every early stage of the next trend is going to give you an opportunity to enter, and that is a very important mental principle. You must prepare yourself, right? Not everyone is going to be the same. So guys overtrade, they want to take everyone, they get greedy, they feel anxious. Prepare yourself before the time. Tell yourself, listen, I'm not going to get into every single early stage of the next trend. I'm going to just take the good ones. If it's possible and I'm going to do it, then I'm going to do it, or else I'm just going to go to another chart, go to another time frame. That's the one amazing thing about this online trading, the Forex markets, is there's so many different charts. There's so many different time frames, different instruments that you can look at. If you've got this basic skill of seeing the structure and seeing the early stage of an next trend, you can go on different time frames. You don't have to get stuck at one, right? So especially in the beginning, build your skill. So please understand this. For instance, there was not a good opportunity. You'll see a little bit later when we go to the candles, when we activate the candles. And there definitely was. The structure of the market, this wave pattern, this is how we manage our risk. There it was difficult. There, very fast movement, very difficult. Right. There might have been an option we'll see later. There was a good structure, market wave structure to get in. And there was another one. There, very, very fast. There was another good one. So we have to decide. So let's jump in. Let's see. Right. Now we do bring in the candles only to see the emotions. Now, very, very important. I'm waiting for the, if you can see there's an uptrend. I keep it in the line chart until it breaks through, until it starts making, it starts looking to me like there's a possibility, there's an early stage of a next trend. So when it breaks through there, okay, so that's a very important principle. We want it to break through. I'm going to repeat this a couple of times. I mean, I'm actually also going to show you it defined. Remember, I said simple and well defined. It's part of the learning process. So it's just part of the revision. We want a break. That's the early stage of the next trend. So there somewhere we will look for a nice what we call a pullback, and then wait for it. I'll show you how we do it next. Right. So there's a couple of opportunities as you can see here. So let's go through them. But first I want to show you, can you see how fast the price moved there? Was there a good opportunity somewhere there for us to use the wave pattern, the wave structure of the market to limit our risk? No. So you have to decide. Some people decide, yes, I jump in, and you're free to do so. But remember how difficult or how important risk management is. Might work once or twice and then it just shoots up or whatever. Right, there's another one. I like the wave pattern. There's a very fast movement again. Did we have a good wave pattern there to limit our risk? Nope. What about there? We'll see. There, good risk pattern. Now afterwards, remember, we can see it doesn't work out, but the pattern is there. So we're not trying to predict the market at that stage. That was a good trade. That was a good wave. So we'll see how it works out later. Remember, always, we cannot. It's not possible to win every trade, and we're not trying, because if you're trying, you think you can predict the market. Lots of mental pressure. We don't have to do this. We take a calculated risk because we understand what happens here. We understand the structure. Right. There is a fast movement again. Not a good option. So let's jump in. This was our first trade. This was our first opportunity. There, I decided I don't like it. There's no good waves. What happened here? The market went down. It broke through. Pulled back there, and then started going up. Let's look in a little bit more detail. So I zoomed in a little bit. So here was definitely a downtrend. Lower tops, lower bottoms. There, the price started breaking through. Started pulling back, right? So we can see there the price broke through the 34, started making higher tops, higher bottoms. So that's an opportunity for us. We can use the wave structure. What I did is, I'll show you now when I take the next step, is we use the Fibonacci extensions, right? So there is this stage, I see the opportunity. It's broken through, it's pulled back. I put my entry just above the higher top there, and I'm waiting to see if the market still continues down. I would move that one, but as soon as it makes a higher bottom here and starts moving up, then I can leave it there and wait, and then I'm willing to engage there, and that is what happened there. So there we waited, the market turned, we put our stop loss there, we used the structure, and there we were engaged. Market pulled back, we waited, there was our first take profit, there's our second take profit. In this case, we're going to use 3 take profits, right? I'm going to show it to you guys now in a well-defined way as well. Why do we use the Fibonacci extensions, right? If you don't know why, if you want to understand, want some more deeper insight into this, it's fascinating. It's based on mathematics studies of a guy named Fibonacci, and I don't know, I use some different guys pronounce it differently, right? But the bottom line is he did lots of studies, and this is part of the application of that. And lots of people have done studies, also our own head of education, and he's got a recorded webinar, which if you log on to my FXTM, your profile, my FXTM, if you log on there, then and you scroll down, if you search, you'll find the Fibonacci strategy, where he explains the research done behind this and some of the reasoning. Right, the bottom line is the purpose of this is what we call a high probability risk management or money management system. Meaning, we used to structure the market here. The market came down, it went up, it made a higher top, it made a higher bottom. So there was a shift in the balance between the buyers and the sellers. We use the indicators in the sense of we see how it broke through the 34 and it bounced back. It came back to the 15. Right. We use that structure while it's pulling back. When it starts going up, we put our guidelines. And if you don't know how the guidelines work, how to do these guidelines, please email me. This is quite easy to do. So then I'll show you how to do it. Right. So and then we put stop orders there. In this type of method, we use stop orders, and then and while we're waiting, if the market engages that, when we've got a open position, we take a calculated risk, and now we're expecting the early stage of an next trend. We're expecting an uptrend, right? Now the wonder of this Fibonacci is that, and that's why we call it a high probability. There's always a high probability after so much compression. Remember the spring. The spring wants to unfold, there's a high probability the market will go in our favor for a short while. So if you take partial profits there, there's a number of ways to take partial profits. In the lower time frames, you can do it manually, or else you can just split your position into 3 different trades. In this case, taking one there, one take profit there, one take profit there. All the stop losses will be there. One position, three trades. One trade, 3 positions that you split it in. Same risk you're taking, right? So you are going using the market structure. There we take our first profit, and now your mental, the risk is not so much, depending how much obviously profit you've taken. And then you wait, you give the market structure, you give the market a chance to reward you, to show you what it wants to do. So they took out the second one as well. We take another portion of our profit off, and now we should have a break even or a net profit trade as well. So, and then in this case, the market just dropped down. The most important thing for me to express is we don't move our stop loss in the beginning. We after the first one, we may move it a little bit to bring it to break even, depending how much you take, how much profit you've taken there. Then, but we give the market room to breathe. It happens so many times that the market goes up, and then if people move their stop loss up too quick, then they get stopped out and they miss out on very nice profits. And we need that profit. This is a business. We need to listen to the market as it speaks. We need to allow the market a chance to give it what it wants to give. Right, so in this case, you had a net profit, and somewhere there, obviously, because this was a lower or higher bottom that was violated, somewhere there you could decide to take the rest of your profit off. Something is drastically going wrong here. The structure of the market has changed. Right. Now, just to emphasize, I've written out this as a rule. There's a good purpose why I didn't do it first. I want you to see it applied first. Right. Now we're going to discuss it. Now you've seen it. Now it will make more sense. We want a confirmed trend, guys. We want those, in this case, we want the sellers to compress that spring a lot. We want a confirmed trend, a nice confirmed trend. And then we want a breakout of that trend. We want to know that there's, in this case, there were sellers, there's buyers coming in, right? And we wait for that market structure. The price must be above the 34. The purpose of the 15 moving average is simple moving average, simply to help us to identify that pullback. If there's no easily identifiable pullback, then it means it's difficult to manage your risk there. So if you just enter, you could just turn around. It's just difficult, right? And then we enter when it breaks out of that higher top, right? So the exit rules, very simple. You've got two ways. I like to use the market structure. So normally the last highest bottom. We're going to discuss a couple of them again, so you can see, you can remember. And remember, please, this is recorded. So if you want to watch this again, just let me know. I'll send you a link. They might or not put it on the website, but it is for a couple of months at least. It's on the GoToWebinar website where I can give you a link so you can go and watch. Right. So you've got two options. You can use the structure of the market, the last last higher bottom, or you can use the 34 simple moving average. The reason why I gave two is because sometimes if you're not sure, then you've got a choice, right? And sometimes the simple moving average is it's too close, so it's actually closer to the entry than the higher bottom. Then I choose the higher bottom. It's just a guideline to help you, right? And like I explained, we use the 161.8. That's where we take first profit, right? The second profit we take at the Fibonacci, the second one, and the third profit we take at the Fibonacci, the extension, the 423.6, right? High probability money management. This is one of the things that fell into place for me the last time. I had good, I could consistent in everything, but I was using a low probability money management or risk management system, meaning I wanted a lot of profit. I didn't take some of it off. I didn't manage my risk. Manage actually not the risk, more than the risk for me is the mental pressure with an open trade, right? Especially when it gets into profit, and the more profit it gets into, if you don't take some, the pressure gets enormous, and your emotions just start mixing in, right? And if you do use a low probability one, and for some reason you've got that stress, just whatever happens if the market spikes back, whatever, you've got that stress, and then it does, and then you close it out, and then it continues, and then you nail yourself again. So it's a it's a whole mental mess, right? Knowing and using logical way of taking profits off keeps that stress low, and it's easy to be consistent. And that's the one thing we want in this business. We want consistency. Mark Douglas in Trading in the Zone talks about the threshold of consistency. If you can practice this basics, a simple, well-defined method like this, with good money management, good risk management, knowing where to take your profit, then you can become consistent, and that's that consistency. Taking every good opportunity that's going to give you your net profit over a series of trades, right? And that's a difference between a good trader that's consistent and stable, and he actually makes a net profit over a series of trades, and the guys that are entertainment trap. They're still thinking they can predict the market. They don't want to get rich, as quickly as possible. They don't manage that mental stress, and it bombs them out. It creates those enormous pressure and emotions that causes people to do irrational things, even when they've got a good trade open. So, and afterwards you say, no, why did I do this? Right. We're going to look at another long one following that same thing, that same pattern here. We skipped that one. There was no nice pullback there for me in the early stage anyway. We took that one, right, and we had a profit with that one. Let's see what happens here. Obviously, I'm going to take it. There's no good pullback for me. The rhythm it's not so good. Structure is not so good, but there's a good one. So some people think the gap is a problem, but let's look. Right, we've got the same thing. We've got a downtrend. We've got lower tops, lower bottoms confirmed. The market starts moving up. Right, it starts going up. It breaks the 34, and that's why I say the indicators guide you. But you don't focus on the indicator itself. What is the structure of the market telling you here? It went up, it went down, we wait, and as soon as it starts turning around, we can put our guidelines in. We can put our Fibonacci extension guidelines in. Right. I waited. In this case, the market went up. We do nothing. I actually kept it on the line chart. When it started moving down, I switched from the line chart to the candlestick chart, and then I wait for that. Is it going to make a lower bottom or not? If it just goes down and makes a lower bottom there, then the downtrend is still intact, and I just wait. Right, but it doesn't. It's a clue. It's a warning. Remember, it doesn't. It starts turning around. So when it starts turning around and it's going up, then I put my guidelines in. I'm willing to take a calculated risk. The spring is compressed, guys. I'm willing to take a calculated risk there. If the market goes past that, I put my stop orders in. It's a 4-hour, so higher time frame one. So I split it into three. Split one position, 3 orders. All the stop losses are there. The first take profit, the second take profit, and the last one will be up there. Right, let's see what happened. I do see that happening, but I'm still convinced the structure is all right. I'm willing to take a calculated risk there. Always a calculated risk. Even if you just learn this, take a calculated risk when there's an opportunity. Then at least you won't blow your account, even if you have a couple of bad trades. All right, so let's see what happened there. It engaged us. Came back a little bit. We wait. We know, we respect the structure of the market. There it takes our first one. It pulls back. The wave structure is still intact. It starts making a little bit of things, but it doesn't start making down moves. Goes up again, takes our second one, and then something happens. Then the structure of the market changes. Right. And there, when it breaks through there it makes a lower bottom. Then I'm thinking about there's either a next trade coming, or I'll take my profit there, right? So that's a choice, is up to you. Right, so we've got a second one there. Let's look at a short trade now. So we've caught that one. Again, we made some profit. Right, so what happens now? We see the market's going up. There's an uptrend. It breaks down. We're still on. I like this the line chart here. It breaks down. When it breaks down and starts coming back, let's zoom in. Then I jump to my candles because I want to see now. I see the uptrend, lots of buyers in the market. Something happened here. We don't care what, we can see. There was started making lower there. It made a lower pull down there. It made a lower bottom there. There was a previous lower bottom. There's also a bit of a lower one. So it definitely made a lower one there. So what do? The market, we wait still. The market tries to go up. If it made a higher top there, it's just a continuation of the uptrend, but it didn't. That the buyers couldn't get the price higher there. They weren't willing to buy. So what happened? It turns around. The moment it turns around, I put my guidelines there. I draw it in from the entry. That's why I'm willing to take a calculated risk. I use stop orders. I don't use market orders or limit orders. Put my stop loss guidelines there. I put my stop loss there, and I'm willing to take the risk. I'm willing to take a calculated risk. This is the way I see it, right? This is very important as you practice also. This is the way you would see it in the live chart. You're simulating, you're training your brain. Let's see our time, still fine. Right, and that's how it works out. It's engaged, we take a calculated risk, and we respect the market. We see what's going to happen. It goes down, it goes up, still all right. I don't like that. That is not good. It might have taken us out there, or might have not. If it had taken me out there, it was still a good trade. I took a calculated risk here. The market structure was right, and I protected my account. Very, very important. This loss is part of the overheads of my business. There's nothing wrong. If you are not willing to have a business or have overheads in a business, then the business will just not exist. If you want to have a supermarket, but you're not willing to pay the rent, to pay your suppliers, to pay the people that work for you, that's overheads before you get the profit. If you're not willing to do that, then you won't have a business. You know, where you're going to have your business because you don't want to pay rent. Who's going to work for you? Right. It's a very, very important principle, but people don't think about this. So this loss was part of a good trade. This is actually where also when I discussed it, the difference between profits and losses, the association people make with a good trade and a bad trade. Normally, when I ask, okay, Ikam, I see a question here. Ikam said, should recap, sorry, but I've got limited time. So what you can do is just send me an email. I'll put my email up later again, and then you can, I'll email you the link for this, and you can watch it from the beginning. Right? Okay. But do watch it to continue watching anyway, because then if you watch again, it's going to be repetition. It's good for the learning. Right. So what we've got here, what is a good trade and what is a bad trade? Normally people associate, newbies associate, or amateurs associate a good trade with they made profits, and they associate a bad trade with they had a loss. That is totally wrong. Totally. And it will break you. It will cause enormous mental stress. Right. And you will not get that consistency. Why? Right. A good trade. The proper definition of a good trade is we respect the market. We respect the market structure. There was an uptrend. There was a beginning of a downtrend, early stages of a new trend. We don't know what's going to happen. At that point, when we put the orders there, this was a good setup. Early stages of the next trend, we use the structure of the market. That's a good trade. We take a calculated risk. That's a good trade, right? We let the market do the speaking, right? We allow the structure of the market to guide us. If we got taken out there, it's fine. We took a calculated risk based on the market structure. It's a good trade, right? We protected our account. If any time, what is a bad trade then? So a good trade has got nothing to do with a profit or a loss, right? If you have a profit, that's fine. If you have a loss in this case, you protected your account. It's an excellent thing. It's a good trade. We want to consistently do good trades. If you understand the language and you practice your executions and stuff, then the possibility of making a profit over a series of trades just becomes overwhelming, right? What is a bad trade then? A bad trade has got nothing to do with a profit or a loss. I can't emphasize that enough. So I can have a profit and still it can be a bad trade. Right, let me explain. So here I took a calculated risk. Right, so let's say I waited here, and when it started pulling back, I decided to cut it here. So I'm not respecting the market anymore. Many times, the market will just pull back because it's part of the structure. There's not a breakout yet, and it will continue, and you're missing out on a lot of profit, right? Because of emotions. And normally that happens because people are risking too much of their money there, or they have a lot of fear, right? So they're still associating a loss with a bad thing. So that cutting there is the bad thing. That is a bad trade because you didn't respect the market, right? And if you don't respect the market, then you will not last in this business. You've got to respect the market. So we let it pull back, and then it continues or not. And then if we are taken out, if we manage our profit, wonderful. If we have our loss, we protect our account, wonderful. A bad trade is we don't follow that. We don't respect the market. We normally the guys start the opposite. They let their profits or the losses run because they're afraid to cut, and they don't know where to take a profit, so they take small profits if the market makes a lot of noise. But the structure is telling because they don't respect the market, they don't understand the language. Now that's a bad trade, right? That causes you to get out of trades where you would have gotten a profit, and to not get out of trades where you should have protected your account. So that's in any business, that's a recipe for disaster. So in this case, let's assume it was taken out, still a good trade. All right, let's jump to the next one. Or let's just follow through the short entry. It's exactly the same. The short entry rules is exactly the same as the long trade, just the opposite. We want a confirmed trend. We want a lot of people to be involved. Oh, I see the time is going. Let's move. We have a confirmed trend. We've got the spring being compressed. We wait for that breakout, the early stages of the next trend. When the spring still has some power, we know it's going to go. Right, we're willing to take a calculated risk. The price must be below, this time below the 34. Must pull back again to the 15, and we entered the break. when the lower bottom in this case. Short exit, exactly the same. We can choose the 34 or the last lower top. Look at the structure of the market, guys. Let that guide you. And we take the profits, right? Yes, we take it in 3 batches, right? So let's look at another one. I wanna cement this in your brain. This happens every single day. The structure is there. It's on all the time frames. Just a word of warning, when you are new to this and this structure is not so obvious to you, please practice on the higher time frames, the 4 hours, the daily, because the structure is a little bit better there, just to get your, to get your eye in. The lower time frames, yes, a lot more opportunities, but there's more noise. Because if this was, for instance, a 15 or a 5-minute chart, then those candles, if it was a line chart there, when I'm waiting, when there's not a early stage, that's a line chart, then it's 15 minutes, the closing price of every 15 minutes. In this case, it's the candles of every 15 minutes. It would be right 15 minutes, 5 minutes, not a lot of people, so there's much more noise. Big guys come in, then it causes heavy spikes and stuff. So you haven't got this nice one, especially when the market closes after not closes, but the volumes become less. Liquidity, the buyers and the sellers become less after the sessions are over, the New York session, the London session, so on. Then you get spikes. You get we talk about porcupine markets, or the market just goes flat or whatever, right? So let's look at this. We've got some down movement here. It looks like it's going to be an up trade. And some people tell me, yeah, but look, there was a possible setup. You are right. Let's zoom in somewhere from there. But it went lower. So the downtrend continued. And then we had a nice trade there. And let's look at it. It went down. It looks like it would have broken up, broke up there, pulled down. We waited for the pull down, nice pull down. And we could have put our structure there. But look what happened. It didn't engage. The price didn't go up. More sellers into the market. And it continued, right? Made a lower bottom there. Then we wait again. And what happened this time? It went lower, it went up, it broke through, started pulling back. A nice breakthrough, a pullback. And there we put our structure. We put our entry there, we put our stop loss there, and we have our take profits. We know what we're going to do. Very, very important. We're not wondering, we're not guessing, we're not jumping, hopping from one strategy to another. We're looking at the structure of the market, right? We're using a simple way to take a calculated risk, and we know we're going to take our profits. We know we're going to protect our account. It's critically important. So what happened here again? The market pulled back. We entered while the market was going up there. We entered we respected this structure. We put our stop orders there, and we got engaged. And sometimes this happens very quickly. It takes our first take profit, second one starts pulling back. You could have taken your profits there, or you could have waited. So yeah, already had your second take profit. Doesn't matter if you waited or you took it out. And there, obviously, you would have taken the rest of your profits out. Something is happening there. The structure has changed, right? And so just part of the lesson, there's no decent pullbacks there. So I would have not taken it. There's no decent pullback. And a couple of candles pull back to the 15. Right, let's continue. One last one. The price went down, and there something happened again. Nice breakout there, pullback. Let's look in more detail. There was a downtrend, lower bottoms, lower tops. Breaks through, starts pulling back. While it's pulling back, if it continues down, we leave it. But if it starts turning around, I put in my structure, put in my guidelines, and I put in my stop orders, and the market goes right. Takes the first one there, second one, and what is nice, if you practice this structure, while the other guys are stressing with this pullback, you're not stressing. You respect the structure. You learn to respect the structure of the market, right? So that's like respecting the waves of the ocean. If you respect the waves of the ocean, then you're very much safer in that ocean. People that don't respect it, that think they can play around, get problems with the ocean, right? You must respect it. And it's the same with the market. So we respect the structure of the market. We wait here. What I normally do is, when my trade is engaged here, I go back to the line chart and I just monitor it every couple of sessions. If it's a 4 hour like this, I would every once or 2 or 3 or 4 even candles, I'll just come back, because my orders are set. I'm going to respect the market, and going to wait until to see what the market does, right? In this case, what happened is we got our first one, touched our second one, and then started coming back. So there I would have taken the rest of my profit off. Right, guys, very, very important. We are almost done. This is very, very easy. This is basic. If you're not sure, watch the recorded video again, recorded the webinar again. Keep it simple, guys. Keep it simple. I can't stress it enough. Keep it simple, right? You don't need complicated stuff to make this business work. This is a business. We need cash flow. We need a net profit over a series of trades. It's a structure. That's our foundation, the simple method, the risk management, and then the practice over and over and over. I'm seeing guys that respect this, they practice, they take the time to practice, they make it their own, and it doesn't take a lot of time for them to start seeing, to getting the confidence and slowly building up their accounts. Right, what do we need? We want to we know exactly what the entry looks like. I think this qualifies, right? We want to know where to take our profit and where to get out when it's wrong. We want to know exactly how much risk we're willing to take. Calculated risk, very, very important. I have some questions about this. People say, especially in the beginning, how do I do lot sizing? How do I calculate my risk? Don't worry about this. In the beginning, what you do is, even if you start practicing your executions and demo account, just start with the least amount of a lot size, a 0.04 in this case. Because what we do anyway is we take a 50% profit at the first one, so and then 25. So in that case, if I was testing on my demo account, it would be 0.02. I take profit at the first one, and then the second one 0.1, 0.1, right? So keep it easy and just build it up from there. If you can do a couple of good trades, I talk about sample sizes. That's what Mark Douglas also talk about. You practice a couple of sample sizes and then see how you're doing, how you're feeling. Are you getting the consistency? Are you still making mistakes? What is the mistakes, right? And you learn and you grow, right? And then if you can do at least 10 or 20, whatever, good trades, nothing to do with a profit or a loss, then you upsize your lot size a bit, or a little bit. You put some, you add some weight, like when you gym. When you start with 50 Ks and you're building, you're pressing, you add about 10 or 20, you push, you add 20. You don't add 100 or 200 at a time. You would get crushed. So that's what people do in a sense with trading. They trade a little bit and they think, man, I've got this, I'm going to get rich. Now they're gymming nice, they can bench press at 50 and then they add 200 and they get crushed, right? So don't do that. So, and if you do it, learn from it and don't do it again, right? We completely accept the risk. That's a lot to do with how much you're risking. If you're risking a small amount, then the mental pressure is not so good. And it's easy to let the market do its thing, and especially when it hits that first target of yours, that first take profit. But if you trade a lot of your account, the mental pressure is difficult to handle. It's high, and then it's difficult not to intervene or not to mess with your trades. So that's why I suggest when you start with the least amount that you can, or the least amount of pips, and then you practice. If you can make good trades, then you up the size, you up the weights. Just see a couple of Rulof said, why not take 100% at level 1? Rulof, we don't want to take 100% at level 1 because sometimes the market want to really be generous with us, and we need that profits in our business. If a customer comes to you and you're selling something and he wants to give you more because he feels this is very good value, and you go and check and you see, yes, you are not asking enough, you take the advice of that client. You ask a little bit more because in the long run, there's cycles in businesses as well, just as there's cycles. You might have losing streaks. You need those profits to survive in the long run, right? Guys that take that don't. I'm going to go back quickly here to just illustrate. What happens here is guys take their profit off. Let's say you take 100% there. What happens is the market wants to give you much more. The market structure there is still not broken. Now you've taken your 100% and now the market goes up and it goes 2, 3, 4, 5 times that. You needed that profits. What I normally do is I take my profit. It's the second one. I take also like 25%. So now most of my profits are out, but you get those times when the market just really wants to go. And that last trade, makes you more than this first double, more than that. So by respecting the market, by allowing it to give you what it wants to give you, right? So you are stabilizing your business, right? But by taking some off, partial profit off here, you're managing your risk. You're keeping the mental pressure low, and that makes it easier to allow the market to give you more if it wants to give you more. So I'm currently in a demo trade with some other people that are trading, which we took on a short time frame, the 15 minutes, and we managed our risk. We took the first take profit, the second take profit, and we decided, because it's part of a higher time frame impulse wave. Beginners, don't worry about this, you'll understand it later. Then we decided to leave the last one open, and we start managing it on a higher time frame, and it's just going. So it's like already 4 or 5 times even this space. Sometimes this happens. The market wants to give you more, and you need to take it. Right. So that's a very interesting thing. Now, when you get consistent, when you practice this, you do the sample sizes, then trading actually gets a bit boring. Right. And that's how it should be. With a business, you know when you're going to open, you know when you're going to close, you know what your prices are, you know who your people are, what you pay them. You need to get that consistency. You need to practice over and over and over, right? So now I've got a short video clip. You plant the seeds, you're busy studying and so on. It feels like nothing is happening, but something is happening, guys. Something happens in your brain while you're learning, when you're getting these basics, and over time it starts growing, it starts showing itself. If you want this to jump up in 1 second, it's just not going to work. It's never going to work with you. And if you're looking for a method that will give you, all this growth in 2 seconds, forget about it. Right? It takes time. You have to train yourself. You have to practice. Right? Risk management. Very quickly. Let's see how time runs. Yeah, we haven't got a lot of time. So very, very quickly, like I said, what happens if you do risk too much of your account? If you lose 5%, you have to make 5.26% to get to break even. It's possible. Let's jump a bit. If you lose 30% of your account, you have to make 42.86 just to get to break even. The mental pressure is enormous, guys. So you've lost 30 now. Now you have to make 42 just to get to break even. It gets a nightmare. 50%, it's almost impossible. You have to stop trading and to see what is wrong. If you lose 50% of your account, you are doing something wrong. If you're trading with what most of the professional guys trade, smaller, like 1-2% of your account, it means you've had 25 losing trades. Long before that, you stop and see something is not right. Right? You have to go back, see the basics. What is happening, and identify it. And then obviously, when you've lost everything, 1,900 to recover, that's not possible. You have to go and save some money, do something else. Okay, regrow your capital. Okay, very important for me. What do I do now? This is not entertainment trap. I don't want you to get stuck in entertainment trap. You have to do something. You have to train yourself. You have to take hold of this. So what do? You need a plan. The market has its rhythm. You have one too. You have to figure it out. You have to have a plan. What does that mean? Very practically, it means you're going to practice. You're going to figure out when I'm going to sit, where I'm going to sit, and then you're going to try, learn, and grow, just like learning to walk, talk, any career that you want to do. And you figure out the basics. I've given you the basics. The structure, this is the basics. The early stages of the next gen, this is the basics. This is the language. This is technical analysis, right? And you can try and learn and grow. And then if you continue, you will master it, right? If you continue, if you never give up, if you just continue and you do it right, then it gets easy, guys. Now, very, very important. This is the questions you have to answer. You ask yourself, what is the routine that I'm going to have? What time have I got available? If you're working, it's going to be different. Perhaps you take an hour or half an hour, whatever. After time, you talk to your family. This is like studying. This is applied economics. Economics is just the careful management of all your available resources. Economics is based on supply and demand. All needs that we have, supply and demand. That's the root of supply and demand, is needs that we have. If you have someone that has a need, somebody that can help with that, and it's a good product or a service at a good price, then you've got a win-win situation. That's good business. That's good economics, right? So what are you going to do? What's your routine going to be? When are you going to have time for that? How are you going to do that? Equipment. Don't go buy new stuff. Use what you have as far as possible. Keep the overheads low. It's also a business principle. Where you've got to get a place. Get yourself a dedicated place where you sit and you associate in your brain. This is where I study. This is where I study applied economics. This is where I study the structure of the market. Right? Who's going to help you? Get your family. Explain to them what you're doing. Don't hide it from them. That's deadly. You want support. You need somebody to support. That they help you to remind you to, okay, go and study now, go and check the rhythm of the market, go and practice that entries, depending how where you are in your process, right? And very, very important, simple, well-defined, stay focused. Don't make it complicated. One example is if you work and you can only trade the daily time frame, it means you're only going to check from Monday to Friday once a day after the New York close. That's for in South Africa, it's about 9-10 you can check. And most of the volume, most of the volumes are out of the market. You can check and decide, is there an early trade stage of a next trend or not? If you trade the 4 hours, obviously there's more opportunities from Mondays to Fridays between 8 and 4. Then you'll get some opportunities. You'll get some golden spots. Just have to check every 4 hours. 5 minutes if you've got more time. Some guys I know work and then they come back from work about 5 and then the New York market is still open. And then Mondays to Fridays, you can in London open, New York open. You can in the first couple of trades or hours, there's always good volume. You get some good structure. You get some good initial stages of an next trend. Very, very important. You are not alone, right? You don't have to struggle through this alone. Forex Time has got a website where you can learn the basics. You can familiarize with yourself with this type of business. We've got it's not a mentorship program, but we're trainers that train our clients. This is part of that. I've got the support groups. This is my Skype. If you miss it now, then you can just email me and I'll send it to you. We've got Skype support groups. I've got beginners that I help. We talk about it. I give them webinars to look and then we discuss it. When you go this route, when you make the effort, then your learning goes up. Your learning curve goes extremely high, guys. It boosts you very much. I've got guys that's been trading for a while that's stuck. They just make profit and give it back and they don't know what's wrong. Contact me, we talk, and I help you to get out of it, to get back to the basics, to fix the foundation. Right, there's two sorts. Like I said, it's the beginners and then the more experienced guys. If you're serious about this, make a date, make a time, email me, and we start. All right, talk about it, think about it, discuss it with your family. If they, for some reason, don't like it or whatever, be careful. You want support, you want their support, right? Explain more detail. Perhaps I have a bad experience with somebody that traded that didn't know what they're doing and they're just blowing their accounts. I've got a good example there. People tell me, no, but this is not a good business, or the Forex is a scam or whatever. Then I tell them, okay, a car. A car is a very dangerous thing. Lots of people have accidents in the car, right? So why do you have a car? It's not the car, people. It's not the car that's the problem. It's the person. Either he can't drive or he was intoxicated or whatever. It's not the car's problem. It's the same with this business. It's not the Forex itself that's a problem. It's people that don't have the skill. They don't understand the language. Okay, if you make time and you study, then it is possible to make a net profit over a series of trades, right? Okay, there's my email. If anybody missed it, please just write it down and send it to me. I get too many requests, so I don't. I see there's already somebody, Austin, saying, can I email you? There's just too many people. Austin, please write it down, email me, and then I haven't got time to follow up one by one. What I do is I reach out. I reach out via the webinars. If you contact me, I give out my email. If you contact me, then I will follow up and we make a date. But I'm not going to press you. I'm not going to try and force you to do anything, right? I haven't got the time for that. I want to work with people that really have a passion for this, that want to do this. And it's very important while you're still looking at this. There's two groups of people. The first group is people that really have a passion for this, that want to learn this language. Now, not everybody is like that, and it's understandable. Not everybody wants to become a doctor or a lawyer or a plumber or electrician. So that's not the point. But all of us want to retire one day. So in a sense, we are all long-term traders. So the first group is the guys with a passion. The second group is the guys that they also need to understand the language, but they don't have to become, I talk about poets of the, poets of the market. They don't need to study the language in such detail. For that, we've got a very, very special thing, which we call Forex Time Invest. And what happens is you can actually look at people that do have the passion, that do have the skill. You can evaluate them. There's lots of them. You can see the equity curve as a special account, which the guys make. They open their own account. They trade their own account. And you can see the equity curve. You can see the drawdowns. You can see the risk profile and what they make and everything. And then you can open a investor account. And then you can, it's your own account, your money is under your control. You've even got protection levels and stuff. But you can then link your account with that guy. When he's trading, when you decide upon a guy and he's trading well, then it means you make profit as well. There's what we call a profit share. There's a whole webinars about that as well if you want to check in more detail. But it's an excellent way to build hear me very clearly, it's not a get rich quick scheme, to build a good portfolio. Right, if you choose you guys good and you manage your risk good, then you can build up a portfolio that way, right? So that is the way we can help both people. So we're training these guys with that becomes, like I call, the poets of the market, that understand the language, that can, that deeply understands it and practice it. And then you can actually get other people that they provide capital. They also take the risk with him, but they check him out first, and then they both make profit. And the guy also gets profit sharing, so he gets a part of that profit. Normally, the average share is about 30%, 70%. So the strategy manager gets 30%, and the other guys, the investor gets 70%, and it's a good deal. So and you can build it that way. There's also risk management involved. So you have to know something about it. If you're not sure, you can email me. I'll get you to some. I've got a nice webinar that I did about that gives you all the information that explains what I mean about this. I talk about planting an orchard. So you're planting seed, you're taking calculated risks, just not on your own trading, but investing it with other guys. And again, you must manage that risk. So our time is up. Let's see. Yeah, our time is up. I'm a little bit over. So, but I hope you like this, and please email me. Like I said, I'm not going to email the guys. I could just get too many lists here. So take my email down. Let me know if you want to train further, and we take it from there. Right. Good night, guys, and I hope you take hold of this opportunity and you do well. Okay. Goodbye.